Good afternoon, everybody. Thank you for coming to the Natural Resources Forum here on diamond financing. My name is Tom B. Saple. I'm a reporter at Bloomberg News. I've been writing about the diamond industry for, I don't know, 6, 7, 8 years maybe. And, you know, in that time, I reckon I've spoken to hundreds of people in this industry. I've spoken to these people thousands of times, and I still feel that most of the time I'm still just scratching the surface. It's a pretty opaque and difficult industry to get your head around a lot of the time, and perhaps diamond financing and the financing of the midstream is the most opaque of the industry. And yet it's essential. The diamond midstream must buy rough diamonds with cash, and they often sell on credit, and so financing has to fill that gap. Right now, it looks like it's going through something of a difficult time. It's quite tumultuous, I guess, maybe is the word to use. We've got two of the big banks, certainly in Antwerp, leaving the sector in Standard Chartered and the Antwerp Diamond Bank. We've had a couple of pretty high-profile defaults and bankruptcies so far this year. There is ongoing scrutiny, I suppose, into some of the practices of the midstream around financing, and I think people are still trying to get their head around how big a risk or how big an issue this is. And yet, at the same time, I think there are some excellent companies out there in this sector doing really, really good work with excellent business models. You know, it's not a homogenous sector. It's not a single sector. There are lots of very, very different companies operating in very, very different ways. And I guess these are the issues we're hopefully going to discuss today and shed a little bit more light onto this part of the industry. We've got some excellent speakers today who are much better informed than I am, so I'm not going to take up much of your time, and hopefully we can move on to them quickly. First of all, there is the ever necessary housekeeping, which I have to go through quickly. The first thing is that the presentations are being filmed, and they're going to be broadcast on the Bloomberg terminal and on YouTube. The Q&A sessions and the panel discussion is under Chatham House rules, so if you could respect that, that'd be much appreciated. The next point, and the most important, is because we're trying to move away from the belief that the diamond industry is stuck in the past, we are adopting the future and going to try and persuade you guys to use the app on your phone. It's a really, really cool app. It's really easy to do. You just got to go into your browser, not on private, and type in nrfev.com. And this is really, really cool. It allows you to ask questions to the panelists throughout the day via a fancy iPad I have here. We've got some polling we're going to do, and it'd be great to get your feedback on that. And you can also order complimentary drinks to your seats on it as well. That's obviously a lie, but hopefully it'll persuade you to download that. So I wonder if you wouldn't mind, anybody who wants to use this, if you go ahead and start doing it now. We're going to run some quick polling in a minute, and it'll be, we'll have a quick test poll first of all. I think the full instructions are here, so you literally just open the browser, type in the address, not in private, and then you're ready to go. So I'll just give you a minute to do that if you're going to do that. I suppose the other piece of housekeeping, is the health and safety. Health and safety is always very important. If there's an evacuation procedure, it'll be announced as evacuate, and obviously please leave and go outside. Right, have we got... Right, I think we're now going to move on to the polling. So anybody that has the app going, I think we can go. And the first question is, have you ever bought a diamond ring? That's a pretty easy one, I think, actually, isn't it? Huh. Ah. Well, look, there we go. Huh? Hmm? That's not bad. I'm not sure when we called it a day, but I think I'm not in the market. Great. That works. Next, this is a bit of a quiz question. Can you tell me what the estimated production of diamonds is going to be this year? I reckon 60% of you are probably right. I hope so, otherwise I'll just destroy my credentials to chair this meeting. What did you vote for, Howard? You'll know the answer.
You're right, yeah, it's 142.
And the next question is, what is the cost of a 1 carat D flawless round diamond? I wonder if the 70% of you who bought a diamond, whether it was a 1 carat D flawless. And did you get ripped off? That's the big question. And I think this is the final question. What is the average time needed to bring a diamond mine into production? Right, that's great. You all seem to know how the app works, and please remember throughout the day, if you have any questions for the speakers or for the panel, or you just want to insult me, you can send a message straight to me through that app on the app there. And now our first speaker is Leanne, Leanne Kemp, who's the CEO of Everledger, which is a blockchain company. So we're looking forward here, we're looking at the future and what these things can do. And, well, that's enough for me. Leanne can tell you about it. So, Leanne, if you could come up, that would be excellent. Thank you.
Hello, everybody. Thank you for having me. It's good to be here. Certainly, I'm discussing blockchain, but I don't like to be called a blockchain company. We're an emerging technology company that started here in the heart of London in April 2015. And my background since the mid-90s has been working in RFID, so radio frequency identification, at the silicon chip and inlay level, and I hold patents in that technical discipline. So I've spent the better part of the last 20 years in track and trace technologies, as well as in harsh environments and mining, focused entirely at production-centric views. You can tell by my accent, I'm from Australia, and of course we're a proud mining nation. So I started Everledger in April 2015 because I was fascinated about what was happening in the space of technology. I've spent the 25 years in track and trace technology, and I'm an engineer. I prefer sitting behind my keyboard than talking with people, so it's a hell of a stretch today to be in front of all of our learned friends of industry right now. When I saw the emergence of technology such as Bitcoin, I began to understand that fundamentally markets are changing. The trust that we have within the world of banking is also changing. And with new technologies, we are beginning to understand what it means to operate in a space without the requirements of intermediaries. And this innovation, Bitcoin, came about in 2008 with somebody or some bunch of people called Satoshi Nakamoto. And he created a world in a white paper where we could effectively transfer money between two people without the need of an intermediary. And on the tail end of 2007, with the global financial crisis, it was very clear that there was a place to be had in the use of this technology. Now, blockchain is not Bitcoin, but what sits below cryptocurrency with Bitcoin is the blockchain. It's a technical foundation that enables you to be able to track objects of value, whether that be money or diamonds in one case, or whether that even be intellectual property, some digital asset, a physical asset, or of course currency. And when I saw this technology and understood what was happening in terms of just the baseline of trust that is starting to dissipate within industry, as well as the fact that we're looking at next generation technologies across the internet, it was clear that the evolution was about to become a revolution. So I began Everledger in April 2015. We look at the very best of emerging technologies. We're a company now with 4 operational centres with 35 staff. We operate in Australia, Singapore, London and New York, and we service customers across the globe. We combine blockchain, smart contracts, machine vision and artificial intelligence, and the combination of these technologies together enable us to be able to provide provenance. What is this item? Where did it come from? Who owns it? And where is it now? These are the sort of the big questions that can be answered with this type of technology. And if I wind forward to today, after April 2015, we've seen the application of this technology now being applied by some of the largest companies in the space, for example, IBM and Intel and Cisco, and they're applying it to other supply chains, for example, food provenance. I've spent the last 10 years in the diamond and jewellery industry. I actually invested in a company in 2007 and focused heavily in the supply chain of the diamond and jewellery industry to support the replacement of goods for insurance companies. So I understand what it means in terms of handling insurance, the optics of risk and claim settlement. And so when I began this company, I looked at actually the endemic problem we have within insurance and within the jewellery industry on fraud, fraudulent related insurance claims. And I'll talk a bit about that in the later part of my speech. So we brought a platform of provenance to the market. The enablement then gives us the ability to look at financing, which is one of the crises that we're talking about today in industry. Now, I was captured by the attention, or Barclays caught my attention and invited us as an accelerator as a part of the FinTech program that was running in 2015. And most people look at startups as disruptive, but we like to think of ourselves as a company that's co-evolving the industry, helping to really understand how we can use all of these great sets of new and emerging tools and where can we apply them into the current challenges of industry. But largely, banks are really thinking about what's happening in their space, and they're making partnerships with FinTech. Over the period of the last 12 months and the last 2 years, we've seen massive increases here on this slide. 82% in FinTech partnerships are being formed. There's internal innovation of 77% being driven by banks, thinking about what they're actually doing in this space. This slide represents some really interesting statistics and actually shows some brands. 7% of the market in banking and FinTech, ABN AMRO is actually sitting at the bottom of this slide, and it shows where they have physically launched subsidiaries based in the FinTech space, right up to the very top realm where 43% of banks around the globe are looking at startup programs to incubate FinTech companies. We're a part of the Barclays Accelerator. We're also a part of the Open Talent team for BBVA, where we won the Innovation Award. And we are housed inside of the Commonwealth Bank of Australia, both within Australia here and in London. So it's fair to say, why? Why are banks looking at this space? And why and how are they partnering with FinTechs? Where FinTechs aren't necessarily, even though we are wearing jeans most of the time, we're not sort of scrappy millennials that wake up in the morning and think, let's just open a digital bank. FinTechs have the ability to bring together a fast pathway to market, to respect compliance, and working with banking partners have the ability to pressure test this technology in such a way that we can gain customer reach. And it's fair to say that banks over the last 40, 50 years have not changed their legacy systems. And yet we've begun to rethink completely how consumers interface not only with the internet, but of course with other tooling and messaging. And that is digital banking on the mobile. This is a great slide. It's actually Pac-Man. So it shows you again how old I am. It's really looking at the center of the API economy, what is happening inside of the digital banking platforms of the banks. Now, if you have new emerging technologies coming into the market that questions the ability to say, do we really need an intermediary that captures all of our information, or do we actually form the bank in such a way that can provide a platform for digital banking? And there are a number of banks in the space outside of the diamond industry that are largely building on top of the API economy. One of the leads in this space that we're intimately knowledgeable of course, is BBVA. And their purchase of 2 FinTechs more recently, and the fact that they've announced that they do have a digital banking platform. We've seen also here in the heart of London, new form banks being built on top of a debit MasterCard, which now, of course, has been gaining a lot of attention with Monzo, who have recently legitimised themselves with a banking licence. So banks are changing. Banking as a platform is not going away. And we believe provenance as a platform is also something that's required to enable transparency across this industry. So blockchain, what is it? It's quite simple. It's the ability to be able to bring together a set of data houses that live across a business network. So instead of relying upon a central repository of data stored in one location that's siloed and unable to be shared, we take that information into a business network to enable that same set of data to be shared amongst those participants real time with consensus. So the truth is shared amongst multiple participants rather than relying upon one central repository. Now, the maturity of blockchain and Bitcoin, arguably, and then Ethereum, has proven its wealth and its worth in terms of faster payments. International borders are able to be scaled and money is able to be transferred immediately, rather than the T2 problem that exists in banking today. We recognised when we saw this innovation, we diluted it down to its most potent elements. As this technology is going to form, what are the things that won't change about it? Immutability is one. The ability to hold records in a state that cannot be changed. Records can be amended and appended to, but it certainly cannot be deleted. How can we be sure that we can gain scale internationally rather than transacting only on APIs? And this technology affords all of these four elements. Now, if we understand these elements at the very sort of base level, where can we apply this? It's very clear that enabling finance will require a number of things to become mature. One, of course, is we need an increased set of verified data, not just within one central source of truth, but multiple sources of truth to enable that to be consensus upon so that we know that that voting is truth and correct. Some form of automation in terms of regulatory compliance is an absolute must. MiFID and all of the PCI requirements are heavily costly to banks. And if we are able to automate that through other tooling beyond blockchain with AI and cognitive layers, this then enables us to be able to build new banking regiments. Increased transparency is an absolute must in this industry, and data auditability. If we can bring this together real time across a platform amongst a bunch of participants, then of course there is very little need to have a retrospective view of audit. And then of course we lead into financing. It's a very simple pipeline, it's linear, and of course the world doesn't operate in this way, but of course we don't have VR headsets on to give you a three-dimensional view. So excuse the high-level view. We've sort of highlighted here some of the challenges that we face within industry that are shared from a banking perspective. Document fraud, what is happening in this space? And if we're relying upon paper-based certification or grading reports and paper-based invoicing, it's very clear it's easy to be able to have document tampering. And there are highlights around the world in maturity of these problems. Synthetics. There's no problems with synthetics. The issue is non-detection of synthetics. And how can we be able to, as an industry collectively, bring that together in terms of transparency? Substitution, of course, peppering the supply chain with synthetics is the other issue, and just a baseline of operational efficiency that adds an overhead of costs. And if we're already constrained in terms of margins, then of course this is a major, major inhibitor to any success of growth. So if we look at the baseline of provenance, what does it bring? We have the ability now with science and technology combined with ledgers like blockchain to enable the detection and the reporting of synthetics to be known as a registry globally. We have that technology. Fraud. Fraud in the instance in terms of document tampering. The blatant changing of invoices or matching of double invoices within the industry is something that is real. And it's on the lips and the thinking and the minds of banks around the world. So how's it done? There's two layers. The first layer is there has to be some form of asset identification. How do you take a physical object that isn't inherently connected to the internet and give it a digital twin? Not just the 4 Cs, going well beyond that. At a level beyond just the metadata of the diamond, but a forensic view and capturing all of those about that physical diamond. Now, once we have that asset identification, we then have the ability to start thinking about digital provenance. Where is it in the supply chain? What are those transactional trust elements that need to be baked into the system? And how can we provide a provenance trail? This changes the risk optics that sit within industry and it starts to engage in some really interesting discussions with those that are bearing risk, insurance companies and banks. Outside of the diamond industry and widely, this technology has now been proven across a number of different supply chains in fraud protection. In motor vehicle, we've seen implementations in place where multiple cars are being registered to the same person or are being insured across different insurers at the same time. And that's a mature use case. Risk mitigation generally across the supply chain around KYC or KYS, know your supplier and know your supplier's supplier, is another implementation that has had significant success. Financing channels, which we'll get into in a minute, and identification at the physical level of the object itself. And combating double financing was one of the highlighted topics that we were talking about today. So as I mentioned before, KYC, there is an absolute implementation, the ability to be able to identify those that are participating in trade and ensure that they can trade on top of that identity across multiple participants in industry. Compliance, the ability to manage and marry both blockchain, AI and cognitive together to give real-time compliance across the supply chain is another very large piece where this technology can play. This technology has been touted as the next generation of the internet. And if you think about it today, when the internet was created in the 1980s, it was created as a document information sharing portal. It gave birth to one of the greatest technology companies of our time, being Google. But still, those participants across the internet are largely anonymous. And if we have the ability with technology to identify who is at the other end of that digital transaction, then of course that's not only important to the physical world that we live in, but also the digital world that we're transacting in. So what we once knew was the World Wide Web is now moving towards the World Wide Ledger. And don't get me wrong, this technology is largely exciting because most of the technologies that we've seen before today have been held as proprietary innovations. They've been held by one or two massive companies, for example, Apple. They've given birth to the iPhone. But the community of blockchain and the community inside of cryptocurrencies made a very early day declaration to open source this innovation and technology, to enable this to become a people's technology. So this technology is not limited to a company like Everledger. If you have a nerd, you've got time, and you can understand the technical disciplines, there is no reason why a company cannot take these tools forward and implement it within their own supply chain or larger supply chains. Again, a linear view. What we see in the emergence of this technology is the ability to start thinking about how this could become the rails to enable a trustful level for collateral management on financing. It's very clear that insurance has a place in the world in terms of risk optics, but can it actually apply itself within a banking regime? Can we think about some form of financing when we think about credit insurance? Is the ability to do this? Could they actually become a financial object for us to start thinking about in industry? There are new financial providers coming into the space, whether that be investment through hedge funds, what have you. We're starting to see payment providers that are strange bedfellows really opening up their platforms into industry. MasterCard is a B2B platform channel. It's not limited to the plastic card and me walking in as a consumer. They can have a significant real-time virtual card settlement within industry today. And we're seeing that now being applied with Visa as well. And of course, transportation is also another important part of the logistics of finance. And we're seeing real-time connections across satellite data to enable that to happen. This technology, as I mentioned before, has three really big use cases that will be applied within this industry and other industries globally. One is predictive risk management and measurement. That is definitely one large use case that sits here. Beyond just anti-slavery and what's happening in sustainability, we can really start to look at the risk optics of an entire supply chain. The second is traceability. If you have the ability to identify the physical object and you can produce a digital twin of that physical object, then yes, you have the ability to bring traceability into an industry. And it's clear that if you have that, you have inventory management. If you have inventory management and traceability and predictive risk, then of course you can start to bear a whole nother different world in terms of financing. Thank you.
many of you know well is Des Kilalea from Canaccord. Des, please come on up. Thank you.
Thank you very much, Tom. And I'm not going to be talking about financing. Excuse me. What I am going to be talking about, though, is some of the assumptions and challenge some of the assumptions in the diamond mining industry that, in a way, bring us here today. Some of the problems the diamond mining industry face in terms of financing have their genesis in actually some of the rather kind of wrong-minded views of the miners and the midstream. So let me just start. Oh, no. Okay. Now, the first thing is that in diamond mining, there's kind of a belief that diamonds are forever. There's kind of a solidity to diamonds that people always want. And it's kind of really born in the fact that diamonds as a product go back to about 4 BC, when the Koh-i-Noor was discovered, for example. So people have always treasured these geological rarities. And the rarity factor actually started becoming rather tattered in about the 1870s, earlier, just before 1870, when the large kimberlite bodies were found in South Africa near Kimberley. So a lot of the problems the diamond industry faces today, oversupply and so on, they're not new. They've actually been around at various times since the 1870s. So, yeah, it's an old industry. It's a rare product, but it faces very modern problems and has done basically since the 1870s. So if we look at diamond mines, one of the rarities that people thought about them is they're hard to find. Fewer than 1% of kimberlites has ever become a mine. They're hard to replicate in a factory. They're forever valuable. They're forever wanted for symbols of love. In fact, a lot of that is true, but what's become increasingly apparent is that although there are very few diamond mines around, there are an awful lot more diamonds being produced because of technology, because of cutting technology. So the desire to wear a diamond still exists, although perhaps not as much as it used to, but the diamonds to fill that desire have become more plentiful. If you have a look at diamond prices, another thing was diamond prices go up forever. Now, De Beers, in a way, was part of that myth, because it used to have a system that actually supported the diamond market. That system disappeared in the early 2000s. But if you look at the chart on the top right, that is rough diamond prices from the Kimberley process. So I guess you would say that's kind of a reasonably coherent set of data. And you can see enormous volatility. And what I would also say, and I'll show you a chart a bit later, is that some of the increases actually were driven by the very reason we're here, financing. Too much finance, too many diamonds bought. Now, the reason I put up this is to show, my title was, are we reaching peak diamonds? Yes, we are. There's no question in terms of natural stone production, we are reaching peak diamonds. This chart here at the bottom left is based on our own data and the forecasts of many of the companies. And actually, with the new Canadian mines and Lesotho mines and the expansions in South Africa, we are definitely reaching a position where, from about 2019, diamond production from the ground will start falling. That is almost, that's certain. There's no changing that. So that would kind of say, well, that's a pretty good business to be in, right? Supply is falling, everybody wants to buy it. But let me just focus on a couple of these. I'm not going to go through all of these. What are the problems with thinking that because diamond production is falling, the industry faces a great future and everybody will want to finance it? Well, number one, margins in the midstream. Leanne talked about some of that. I'm sure we're going to hear more about it. Number two, lack of credit in the midstream, the reason we're here today. Excess inventory, rough and polished. Tax changes, synthetics, resource nationalism. So there are all kinds of reasons why the production side of the business looks pretty good. If you said to a copper miner, we're reaching peak copper, they'd all kind of smile very brightly. But inside that has bred a complacency in the industry, I believe, not to face the challenges that it has coming up to it. And here are the challenges. Diamond jewelry sales have not grown. Top right chart, the little red line, for 4 years, locked around 80 billion. I mean, that's a pretty poor business. You've got to say, that's not a growth business. Look at the bottom left. That is the percentage, the diamond content in jewellery. It's been falling. So we've got falling supply in rough, but actually, who's buying the stuff? Who's telling them to buy the stuff? So there are many challenges, and these are the kind of things that actually people who fund the industry will be focusing on. The other thing is this kind of perception that we can transpose Western data, ownership of cars, etc., to China. I mean, that's just got to be crazy, right? Any statistician will tell you that that's crazy. To believe that just because 3/4 of all US brides has a diamond engagement ring, that the same will happen in China, isn't right. You could argue there's a very big footprint in China. We don't need 3/4. We only maybe need 30 or 40%. But to base an industry growth in mining and in the midstream on a perception that diamond jewelry sales are going to grow at GDP, they clearly have not, is really creating part of the problem in the midstream. The midstream, I mentioned margins. Chart in the bottom right, I must give credit to Bain and some others like Alrosa. The guys in the midstream don't make a lot of money. You could argue they turn their stock a little bit faster, so that understates the real kind of return on investment. But if you've got a bunch of debt, the last thing you want to be doing is earning those kind of margins. It just doesn't make business sense. Tom mentioned some of the high-profile bankruptcies. This is part of the reason. You cannot pay and service debt when you've got that kind of margin. Here's the bank debt situation. This is, again, while we're here. We're talking about new major sources. I would imagine that talk right now of the quantum of new money in the industry, and we've heard Leanne, we've got Chris, we've got the bankers here. I suspect it's greatly exaggerated for the reasons that the know your client and all that stuff needs to be resolved. There needs to be a whole new set of disciplines, including restraint on from the miners to pushing rough into the market when the market doesn't deserve to have that rough. The chart this is synthetics, right? The chart that I really like is the one on the bottom right. It's from Koen van der Bemt from the University of Antwerp. We know that synthetic production is growing. We know that its cost is coming down. I titled it, Diamonds are real, but they're not rare. That is true. And you could argue that actually, as soon as you buy a synthetic diamond, you know it has no resale value. Like you buy a fake Rolex, it doesn't have a resale value, whereas a natural diamond does. The fact is that people often will choose a synthetic. But what that chart shows is that the synthetic is the line that goes from the bottom left to the top right. So at some point, synthetic production will inflect upwards. And if the industry, this is from work that Koen's doing, if the industry, natural diamond industry and the midstream don't actually get to grips with it before it starts hitting that inflection, the chance of influencing, of reducing demand for synthetics over natural will go away and actually probably never to come back. I'm sure there are many industries we could think of where that actually happened. And it's a great chart when it's in its full animation and it builds up beautifully. It was one of the most important charts I thought that we saw in the Brussels Diamond Conference last week. So synthetics is real, it's a real problem, and it's a real problem for those who fund the industry because it needs to be disclosed, and you need to know the true sense of demand before you can actually say, how much money can I lend into the middle? My last real slide. The top left is production and demand. I've grown demand at GDP, and we've got this fabled hungry crocodile. There's not going to be enough diamonds. What I've done in the bottom one is I've said, well, what happens if the percentage of diamonds in diamond jewelry falls from 27 or 28 to 22 or 23 or 24? You know what? There ain't going to be no shortage. So these are issues that the industry has to cope with. These are issues that require rational financing, require rational behavior from the miners, require rational behavior from the midstream, and decent marketing. I've called this the diamond traffic light. I've tried to color in green the things that are pretty good for the industry, in orange the ones that I'm not really sure about, and in red the ones that are downright not right. You only see 2 green ones or 3 green ones there. There are a lot of flashing ambers and there's a lot of red. And these are issues that I hope during the afternoon session we're going to get to grips with more to enable us to feel comfortable that the midstream, which is actually the threatened species here, is properly financed. Thank you very much.
Hi. Thanks for having me today. It's an honor to speak. When the Natural Resources Forum asked me to do this presentation a couple of months back, I was actually busy closing a major financing transaction for Diarough, the group I'm the treasurer of. So for me, it's a delightful today to be standing here, having closed that transaction and having that behind me. What I want to speak to you about today is really how was banking in the olden days and what are the drivers that I think changed the diamond landscape and changed banking to what it is today. And I want to close with, of course, a case study, which is Diarough, the group I represent. I love diamonds, and I love working in the diamond business. I can't imagine another business I would rather want to work for. Maybe a little bit my history. I've been in the diamond business for 20 years. I was a banker for 10 years at Antwerp Diamond Bank, one of those specialized diamond banks in Antwerp, until 10 years ago when I joined Diarough. Banking in the olden days was very much different from what it is today. Didn't quite look like that, but you get the picture. There was a lot of specialization in the diamond business. Specialization in the form of companies that were specialized in rough trading, buying rough diamonds from the miners and selling them to the market. Specialization for manufacturers. Manufacturers were buying rough diamonds from the traders and selling them to the polished wholesalers. A lot of companies out there, smaller companies, all doing their specialty. There were also geographic differences. Antwerp was known for rough trading. 90% of all the rough diamonds passed through Antwerp. New York was known for polished trading. Same was there for Hong Kong. Israel and India were manufacturing centers. So a big spread of differences geographically, and the banks in all those locations were specialized in financing that particular part of the business. Today is very much different. We see less companies, we see bigger companies, we see less financing, and we see less specialization throughout the world. So what has changed? Well, I think everything has changed. And for me, those 7 items are the main drivers of change that brought us to the situation where we are today. Let's look at the first one, technology. Technology has changed the world, as we all know. And the light bulb we see here is something as simple as a light bulb has changed. I don't think that light bulb is there in many of our houses today. Well, technology has also changed the way we run our business. In the olden days, when you would go out to buy a diamond ring, you went to your trusted jeweler and you chose a ring you liked, the ring design, you chose a diamond you liked, and you really relied on the person, on the jeweler, to give you the right value for money. Today, if you do the same, you may still go to the same jeweler, but pricing is out there. You just click on Amazon or click on Blue Nile or other websites, and you'll know exactly if the jeweler is overcharging you or if there's another option that you can find. Now, changing in pricing, of course, brought pressure to the jewelers because they were faced with a well-educated consumer. And the jewelers and the big jewelry chains brought that pressure all the way to the midstream because when they have a problem, we have a problem. I must admit it took time to adjust. It took time in the jewelry business. It took time in the midstream business. And, well, maybe we are still adjusting a bit today. But this is probably the reason why we are still adjusting today. This is what we knew. This is the diamond market in the olden days. We understood it, we found our way in it, but it wasn't too clear and too transparent. So it was when, I think, DTC, De Beers, started analyzing the market, and they found the same picture. And it didn't make sense to them as well. A diamond, when moving from mining to the consumer, passed through numerous hands, no straight added value or value chain. So the Beers analyzed it and they said, this doesn't make sense, and they were right, of course. Sorry. So, absolutely, it didn't make right. It didn't make sense. And what they did was really incentivizing their customer, incentivizing their site holders to grab a bigger part of the value chain, to go for the manufacturers, to go all the way up to buy directly from the miners and go all the way down as deep as possible into the polished market, ideally selling to the consumers directly. Of course, that brought another effect. And the effect was this. Bigger companies were created. Concentrations in the industry started happening, and we created fully vertically integrated companies. Now, with a vertically integrated company, balance sheets of the company started growing as well. If balance sheets start growing, need for finance starts growing, and the complexity of the business increases. With the increase of complexity came an enhanced need for compliance. If a business is just buying a rough diamond and selling it, that's a small value chain, something you can analyze quickly. But the world was changing. KYS, KYC was there. The banks were emphasizing on increased compliance, and so did the business. Increased need for transparency, and that is, of course, a key word in all these changes. Now, if you're looking at all these changes, I think one of the changes that didn't happen was banking. Like I said in the beginning, banking in the olden days was easy. You had simple structures, and you had a simple, one-size-fits-all, tailor-made approach to finance a rough dealer, an approach to finance a manufacturer, or an approach to finance a polished dealer. With more complex business models, with fully integrated companies, came the need for a changed approach as well. Trying to finance the new business with the old way the banking was financing the business was really trying to fit a square plug in a round hole. And that, of course, as we all know, doesn't work. On top of that, what happened in those days was also the entrance of new banks in the business. At a time when the business really needed smarter money, it didn't need more money was flown into the business. And if all wasn't bad enough, 15th of September 2008 happened and Lehman collapsed. The immediate reaction of the business, diamond business, and the banking side of the business was to go into survival mode. The banks, because they didn't know if they would be able to finance the business anymore, well, they didn't know if they would exist the next day. Same thing for the diamond dealers. They didn't know if there was going to be a market after that crash. So really a deadlock in the market. I think what my summary of this first part really is that banking the diamond business today is difficult, not because it's banking the diamond business today is not happening anymore, not because it's specifically difficult or because it is specifically bad. I think it's more a story or a question of who moved my cheese. Things were happening, changes were happening, and not everybody was adjusting as quickly as they were expected to. So let's look at Diarough. Let's look at what we did or what initiatives we took to unlock the situation. And let's do that by taking back a couple of these changes, a couple of these items that we see here. Starting with technology. In a world that is changing, in a world that is changing in terms of speed, in a world that is changing in terms of transparency and compliance, it is important that as a company you have better data, you have faster data. Your business models become more complex, more difficult to analyze, yet there's a need to analyze them quicker because your market is changing at a speed of a rocket. So one of the first things we did was really, pretty brave, I must say, because we had an IT system that supported our business, which had been functioning for years and which really, at the time when we started thinking of changing it, well, was still doing what it needed to be done to do. But what we did is we basically threw it away and we installed SAP. By installing SAP throughout the company, by putting every company in the group on the same platform, using the same data and the same data entry, well, we actually achieved what we wanted. We got better data, we got solid data, we got faster data, and important for financing, and we'll probably see that later, we increased our time to market of data. days were over when you would give your banker a balance sheet every year just before summer when you closed the balance sheet, and he would be happy for another year and come back the year after. We also increased the quality of data. Quality of data, important, because we wanted to give direct access to third parties looking at our business. Today, if our auditors visit us for their audits, quarterly audits, annual audits, whatever, they don't get reports from us anymore. What they get is an access to our system. They know how to maneuver into it, they know how to scrutinize the data that they want, and they're free to do that. We don't have anything to hide. They just go on and they can ask us questions afterwards. Same thing is there for other third parties, like for instance, insurers. Credit insurance in the olden days was basically giving the insurer a quarterly listing of your receivables. That was the information you gave. These days, our credit insurers have direct access to our SAP system. They take a daily dump of all our data, analyze it, and can ask questions any day of the week. So increased transparency, increased clearance in our data. But of course, compliance was changing as well. And DTC was taking fantastic initiatives with BPP, again, incentivizing their customers to take compliance seriously, take KYC seriously. But what we also did was become one of the founding members of RJC. RJC, Responsible Jurors Council, probably known to a couple of you here, really started enhancing the initiative that DTC took through their BPP. So we launched new procedures throughout the group. And the key thing here is really by becoming one of the founding members, we told everybody on the outside, but more importantly, on the inside, within the group, that we took this seriously, that we took KYC seriously, compliance, anti-money laundering, and gave that message throughout our group, which allowed us, or which enabled us to form internal audit functions, again, telling people, look, do what you need to do because we are checking. Creating full transparency. Again, the word comes back. Transparency is key. Transparency to investors, third parties, and internally, and actually adding value to our business. All more compliance is seen as a burden. And look, complying to everything that banks or suppliers ask you these days is indeed a burden. But I think what we have seen throughout all these years is that it also adds value to the way we conduct our business. And then, of course, we come to financing. As I said in the beginning, I was a banker before, and I remember heated discussions with the management of Diarough about banking and about what Diarough needed to fund their integrated business was not, we weren't able to fit that in the standardized and standardized banking models that were there today. So rather than hoping that changes would come from the banks, what Diarough did is they hired an investment banking firm. And they told the investment banking firm to study our business model, to study the diamond market, and also to study financing that is out there, and to see if the two could be brought together. And actually, they found a match. So in 2007, we launched our first securitization transaction, a private placement back then, rated, placed with a good mix of institutional investors and banks. By doing that, we found a good balance between more flexibility and less flexibility. More flexibility because it enabled us, this transaction enabled us to fund the business that is there through all its seasonalities, through all the changes it goes through. And less flexibility because, as you all know, a securitization comes with covenants, and covenants can't be breached. Or if they are breached, they have to be cured. So the exchange was perfectly there, and we found a match. Proof of concept, of course, came in the financial crisis. Having launched the program in 2007, we quickly hit September 2008. And despite that, the program kept performing strongly. So that was really the proof of the fact that we took the right decision. Throughout the years and throughout the years until 2 years ago, we refinanced the program in 2012. Well, not the easiest market either, but yet we got to refinance it with some of the initial investors. Again, a good mix between institutional money and banking money, until we came to 2016. Program we had launched in 2007, refinanced in 12, was up for refinancing in September of 17, so we started thinking about it. And different options were there. A simple roll of the existing program, but we thought, you know what, the program's been there for 10 years, so it's maybe time to start studying it again. So again, we went into the market, hired a new investment banking firm, Guggenheim, and asked them basically the same thing. Look at the program that is there, see if it still fits in today's financial market, because in 10 years, also in the institutional market, a lot has changed. So what Guggenheim did was exactly that. They studied the program, made the necessary tweaks to the program to make sure that it is up to speed with today's requirements, and probably the most interesting they came with, the interesting thing they came with is the idea to step away from a private placement and take that next step in the evolution of the financing of the Diarough Group, namely to launch the program as a 144A transaction. So a public transaction with an offering memorandum. I can tell you I'd never written or assisted in writing an offering memorandum. It's a hell of a job, but we took that next step. We took that step in bringing transparency again in our financing. We took that step in diligence, because the diligence that you undergo as a company to do a 144A transaction is, well, that many levels higher. And probably that is why I'm so proud about the program that we have launched, because it is out there, it is operational, it's active, and it proves that you can indeed fund a midstream diamond business to the rules of the game. So what's next? Well, there's a lot of people in the room here, and I hope that that shows that there is an interest in looking at financing the diamond midstream. As a treasurer, I'm supposed to know how a program like this works, and I hope that I've been able to show you that indeed it is possible to bring a transparent, rated program to this market at balanced returns. That's basically the example I wanted to bring today.
Thank you so much. It's actually great to have the perspective from the midstream. It's often a voice that's missing at events like this. I guess first of all, I'd really like to ask synthetics, squeeze on margins, weak consumer demand. What do you think? I guess this is the crux of what we've been talking about today. So it seems most people seem to think profitability and to squeeze on margins for the midstream players. And the big solution to that is to pay more for polished diamonds. So next time you go and buy a diamond, offer to pay more for it. And I think the next question, and I'm going to have to thank Bonus for the answer to this one, who gave an excellent presentation on synthetic diamonds at a conference in Brussels last week, is what percentage of diamond production is synthetic? They get a lot of media attention, but how big is the actual issue? So people don't think it's a huge amount. Ooh, yeah. And this actually is a trick question, because I believe the answer is about 3%, which means anyone in the top two sections is right. Well, that's probably my fault for drafting a poor question, but you live and learn with these things. I think that the next question again, I think, which is really interesting, is ultimately who is responsible for making the midstream sector more bankable? I guess traditionally the industry has always looked at companies like Davies. So is it the miners? Is it the midstream companies themselves? They have to get, change their business models, or is it the finance providers who need to be more specific in what they ask for when they lend money? there seems to be a pretty significant majority that think that it's up to the midstream companies themselves to get their houses in order. And I think the final question, and I think if you were paying attention earlier on, you would have got the answer to this from one of Des's slides, is what is the total estimated funding to the Diamond Midstream at the moment? Is it more than 15 billion, 10 to 15 billion, 5 to 10 billion, or 1 to 5 billion? And it does look that about three quarters of you were paying attention to Des's. I will give Des the names of the 25% that weren't, and you can have a further discussion. Right, on to, I think that's enough polling for one day. On to our next presentation. Unfortunately, Eric Jens from ABN had a mechanical issue on his aeroplane this morning. He was fine, but unfortunately he hasn't been able to be with us. Incredibly kindly at the very last minute, Chris Ellis from Dfin agreed to step in and fill this gap, so we're incredibly grateful for him. Chris, with his team currently at Dfin, are looking at new ways of providing finance solutions to the midstream, and Chris now is going to come and give a talk. Thank you, Chris.
Thank you, Tom. Apologies for the croaking. I went to see a play last night, and there was a sign in the lobby saying such and such a performer is unwell tonight, and his understudy is performing, and his name is whatever it was. I didn't know either of the names, but I felt this pang of disappointment that there was an understudy. I just assumed. So I know how you feel. And but anyway, thank you. I was looking forward to. Came to this last year and spoke last year, and this year I was looking forward to listening. So anyway, it's nice to be here. I'm going to start off with what I consider to be the good news for the industry, which I will also, if I remember to, end with the good news, just to keep Howard happy. But the good news is that the miners are still mining, the producers are still producing rough, and the consumer, with a few ticks up and down and a bit of geographic variation, is still buying diamond jewelry. Bit less, bit more, constant currency, local currency, however you want to look at it, there's still a very big market for diamond jewelry. It's not shrinking. I don't think it's a growth industry. I think the margins are a problem in the midstream, and or as a firm, I suppose, we have a theory as to one of the possible causes for the skinny margins that look as if they make the underlying businesses unbankable, because with a 3-4% margin, how can you afford to pay interest rates when they become a little bit more normal, and how do you pay back these vast sums that are being borrowed? And the answer is, of course, at least a large proportion of them didn't intend ever to pay back the money they had borrowed, and a lot of people were attracted to the industry not because of these stellar margins, but because of the ease and availability of quite irresponsible and irrational financing, the fruits of which we're about which we've already started seeing coming home to roost, just to mix my metaphors a little bit. So anyway, that is something that is spoken to by the amount of credit that in Des's range, which none of us really know, but I think $12 to $14 million is the current wisdom, at least it's ours too. That's it doubled from 2008 to 2013. Midstream credit went up to probably about $16 million, and then it's dropped back down again significantly. A large part of the increase was triggered by the emergence of Indian banks and Standard Chartered Bank, who came roaring in like a lion. And as you probably all know now, they're going out like a lamb. And that drove down pricing, increased the availability to an enormous extent, and drove up a number of those spikes that we've seen there. So I'm just going to talk mostly about inventory and receivables financing, because those are the two primary assets that midstream companies use to support their debt. Receivables, first of all, traditionally have been a fairly benign way of midstream companies financing their businesses, financing their working capital. Invoice discounting or receivables financing, a very sort of well-trodden path. But it became less benign as people realized that the banks weren't really paying attention. And if you look now at the sort of suite of receivables that are treated with the sort of respect afforded to assets that you'd happily lend 90 or 95% against, you have invoices to sister companies, relatives, you have multiple invoices being issued to one customer because of your concentration risks and the multiple banks lending against all these. You have offsetting receivables, you have receivables going in both directions at once. So company A sells to company B and vice versa. They both run off to their bank, finance their receivables. Nothing changed from one day to the next, except suddenly there's a new amount of financing being put into the midstream for no net activity. And in addition to that, as Leanne referred to, there's any number of just straight out made up counterparties that have issued invoices or have had invoices created and financed. And this is all yet to come home to roost, really, but it's starting at the moment. I mean, the Excelco situation that I'm sure you all know about, the bankruptcy there has banks owed probably close to 50 million US. The trade is owed probably 20 to 25 million US. The trade will get nothing probably when all the dust settles from that bankruptcy. But interestingly, of the $25 million receivables that are an asset of the bankrupt Excelco estate, a large number of the top 10 creditors to the company, if you like, or I should say debtors actually, are also creditors. So there are a number that are owed a few million by Excelco and also owe a few million to Excelco. The problem for them is going to come when the bankruptcy estate says, can you pay what you owe? And by the way, I'm sorry, there's nothing for unsecured creditors. So this is going to start, there'll be sort of knock-on effects from that fairly soon. And who's to say how many of those were legitimate two-way trades or something more calculated to drive financing. The other aspect, though, the one we're more focused on as a business, is financing inventory. And the Diarough program, which was described so nicely just before the break, we're real admirers of how that was put together. We've looked at it very closely, and I think it's fair to say that there are probably fewer companies than you could count on the fingers of one hand who are of good enough quality and balance sheet and history and systems and everything else to be able to pull off something like that. It's just not a trickle-down type of financing. It's available to people like Diarough, and there aren't many of them. And so the rest of us and the rest of the industry who are seeing a clean pair of heels from all the traditional banks in the space are left scratching around. In fact, it was the Diarough principal, though, a couple of months ago, who said to me, in his view, the problem isn't that there isn't enough financing in the midstream, but that there's too much financing in the midstream. And I think I agree with him. It's the wrong kind of financing, and it's going to have to reinvent itself. That's partly what we're trying to do as a firm, is put together an inventory financing program that has the sort of characteristics that you typically see in other fields. The diamond industry has all kinds of quirks to how people borrow money in it, which I'm sure a lot of you are familiar with, so I won't rattle through all the sort of strangenesses of it, but there's a reason why new banks aren't cycling or rotating into the space as the existing ones leave. It's because it's a bit of a head scratcher. If you don't have proper collateral, if you can't value the collateral, if you don't really know what it is, if it's very portable and large amounts of your collateral are capable of disappearing at the blink of an eye. It's not, and coupled with that, of course, the State Department in the US has sort of demonized diamonds for the time being anyway. It's challenging. So what we believe needs to happen going forward is, first of all, the receivables financing needs to become something legitimate again, which will probably require reinvention after this storm has passed. And as far as inventory financing goes, it needs to look and smell and behave like something that non-industry banks are familiar with, and it all makes sense to them, and they can see the collateral, they can rely upon it being there, they know what it is, they have a reasonable idea what it's worth and who's holding on to it for them, and that the companies that it belongs to who are using the working capital loans to finance their business, not to finance their off-balance sheet activities, which is where a lot of the money has gone historically, have skin in the game. You know, they shouldn't be borrowing 100% of their working capital. If they don't have capital of their own in the business, then it needs it. And so there are plenty of companies that fit that description. There are probably many more that don't, but the ones that do are the babies being thrown out with the bathwater at the moment, because the banks that are exiting aren't particularly discriminating on the way out. They're just saying, we're not doing this anymore. So what we're trying to find is the ones that are fungible, bankable, have proper businesses, and are able to operate in an environment that looks like the real world as opposed to the diamond industry. So I think that's the gist of what I had to say on my the back of this particular envelope. So thank you very much.
Thank you again, Chris, and thank you ever so much for stepping.
Well, good afternoon, everybody. First of all, thank you for having me here. So I'm Senior Client Relationship Manager at Channel Capital Advisors, and I'm happy to be here on stage and give you a bit of feedback on what we do and how we see the future. So my goal for this presentation is to give you some background on what, in our opinion, causes the global financial gap, which is notable already today, in the overall trade finance, not so much in the industry, and how to discuss, and then to discuss how this gap and other events that took place in the diamond industry have actually caused the landscape in the diamond midstream to change. Next, I would like to briefly discuss the capital markets and discuss how the midstream sees the benefits of the capital markets for the diamond industry and what they are doing to adjust themselves towards getting access to that market, and also what we as Channel Capital Advisors can do to bridge the gap between both worlds. So let's focus first on how the overall financial landscape has changed in the last decade or so. So the International Chamber of Commerce, for example, has conducted studies on a regular basis, and they have said in 2016 that a huge majority of the participants of the study, of the worldwide trade finance, see that it is the financing gap which is growing, and with more than 50% of credit applications being rejected by their banks. More recently, in 2017, the ICC stated that the financing gap on a global level in trade finance is now at $1.6 trillion. They also point out that actually it's mainly the SMEs which have more of an issue with this financing gap than the large corporates, and they pinpoint a couple of reasons for that to be as such. They say, for example, that if you look at the relative costs of onboarding a customer and doing all the required credit checks and compliance checks of a customer, and you put that against the revenue on an SME versus the revenue on a large corporate, then it's less interesting for the bank to give a priority to the SME opposed to the corporate. Also, the SMEs themselves, which are often family-driven companies, they sometimes don't have the right people on board to actually comply with all those rigorous compliance requirements of the banks. So that's also a hurdle. And then last but not least, the SMEs traditionally, in the eyes of the banks, carry a higher risk weight compared to publicly noted single A rating firms. Deutsche Bank, on their turn, they said in 2014 that SMEs are hindered for access to other financing solutions, alternative financing solutions, given the lack of transparency and disclosure. And then the Bank Association of Finance and Trade, they said in 2016 that due to Basel, the capital requirements are expected to rise, and as a consequence, so will the margins for borrowing money from the banks. Now let's look at the following graph. The following graph actually shows the assets on the financial sectors in the Eurozone. The blue graph represents the normal traditional banks, and there you can clearly see that from 2008 there has been some fluctuations, but overall their exposure has not grown. And due to that, we see that in the last 10 years their market share on the financial markets, at least in the Eurozone, went from 60% to below 45%. And on the other hand, the other financial intermediaries, they have been able to grow their exposure in their market share from 30% to more than 40%. So this clearly shows that the role of the traditional banks is declining, but one cannot make the mistake of thinking that they are not important. Traditional banks are very important for funding and for transactional banking services. So now let's bring this down more to the diamond midstream and see how the events, this financing gap and other events that took place have actually changed the finance in the midstream. So the traditional bank has predominantly been the way of finance in the diamond industry. For decades and decades, they have financed the trade cycles of a very expensive product which requires a lot of funding. So they're typically providing finance which is short-term, uncommitted, and they are secured with floating charges on the assets and corporate or personal guarantees from the principals and shareholders. Now, opposed to the institutional investors, that's one of their advantages, is that they're better suited to provide revolving facilities where you have varying drawdowns and repayments. And then a very important aspect as well of their activity is the transactional part. So they are of an extreme high importance to open accounts, facilitate payments, do forex transactions, and so forth. And also for the capital markets, those services are very important. So the traditional banks are important and will remain being important. Now, to show you what happens on the diamonds, the financial landscape in the diamond industry, I have to take you back in time, where actually in the 21st century has been a couple of huge game changers, and that has caused the situation where we're in today. Until early 2000s, the midstream was very profitable. That means that everybody in the value chain was able to make a decent amount of money as long as they ran a prudent business. And bankruptcies were very rare, and when they happened, they were being solved within the market themselves to make sure that everybody involved recovered as much as possible. Now, since then, we have seen that the operational margins have decreased significantly, like this showed as well in his presentation. And this is, in our opinion, mainly due to the increasing competition in the midstream itself. There have been a couple of very aggressive new entrants, aggressive growers in the industry, and that has caused pressure on the prices, both rough and polished, from within the industry itself. And then, like was always also said before, the consumers themselves became much more price aware, and that caused pressure from the retailers upwards to the midstream on the prices of the polished. Now, in order to survive that those decreasing margins, the midstream had to reshape their business model. They have to make adjustments, cut expenses, go more downstream, or work in specific niches. And the vast majority has been able to do that. However, sometimes they decide at that moment to invest either family or corporate means into other non-core assets, which at that moment were much more profitable. Then, of course, 2008 came, global financial crisis, and that had a huge effect on the overall banks for reasons which were not related to the diamond industry. But the industry itself had its own crisis at the same moment. There was lack of trust, the inventories devalued rapidly over a very short period of time, and receivables were being delayed, money was not coming in time, and this caused pressure on the liquidities of the diamantaires. The banks themselves at that moment were experiencing pressure from their management due to the overall problems they had, and they were pushing on getting those liquidities back into the business in order to make sure that everything kept on moving. Now, how can you do that? Either you bring money from outside into your business, or you sell inventory. Now, if your money was blocked somewhere in non-core assets at that moment, which also experienced the hit of the financial crisis, then it was quite difficult to bring that money back. And there people had to do fire sales of the inventory, took losses, and that has created some kind of a snowball effect, causing them to get into difficulties, causing the banks to take losses, and resulting after following all these steps in increasing capital requirements for the banks. That results in the banks, as from 2008 up until now, to be increasingly sensitive towards capital requirements, compliance, reputational risks than before, and that causes those banks who need to restructure as of following of the crisis, that they have in some cases decided to de-risk from our industry and not so much maybe from other industries. How has the midstream adjusted? So, okay, there have been some problems. There have been some bankruptcies for sure. But if you look at the overall business, then in general, people were able to repay their bank lines up until now with the banks who are exiting. They were doing it through shortening trade cycles, through reducing their businesses if required, through bringing money from outside into the business, or to find replacing funding. Now look at the capital markets and why this is interesting for the midstream diamantaires. I think the advantages of the capital markets are clear for the diamantaires, considering the situation that they are in now. There is an availability of capital. The capital markets have funds available to invest in interesting investments. There is a diversification of their funding sources. They step away from only traditional banks. They bring it to another level. It's committed facilities, which means that they have long-term funding, which is different from the short-term facilities of the traditional banks. It's typically 3 to 5 years, these transactions, maybe even longer. And on top of that, because of the fact it's committed, they have, from the start, they know what the margins are, and at times that people expect the margins of the banks to increase. This can create stability for them as well to estimate what the pricing will be of their borrowings over the years to come. Now, of course, the midstream can't just access the capital markets. It's quite of an endeavor. It's not easy. And they have, not all of them, but the important companies amongst the midstream have seen that it's required to make necessary changes. They are, for example, changing business practices, things which were allowed 15, 20 years ago and which today in the current world are no longer acceptable, have been eradicated. They work with overall industry partners and bodies in order to improve the industry-wide standards, to bring the entire industry to a certain level. They are implementing corporate structures, IFRS compliance financials, and better risk control and data governance and all these aspects is being implemented at present. Important to know as well that they understand that this is only a first step. You can't just do this and then sit back and let everything happen. No, you have to keep on managing, keep on seeing what's happening in the world, and keep on adjusting and going along with how the new regulations and how the new world evolves on the financial markets. Now, who are we? Channel Capital Advisors. So we are a London-based credit manager. We are authorized, regulated by the FCA, and we provide on one hand that working capital solutions for the companies, not only for the midstream diamantaires, but we also have a funding platform on the Dutch SME sector, and we are engaged in overall trade finance in other businesses. And on the other hand, so we provide solutions for these investors to manage their assets. And as I already said, the typical lifespan for these transactions is about 3 to 5 years. Now, what can we offer? First of all, everybody who is busy with the onboarding of these midstream diamantaires takes a very dedicated approach towards the risk management procedures which we have, and make sure that only the high quality diamantaires are being targeted. We conduct a credit risk analysis upfront, and we make sure that all the due diligence is being conducted in order to make sure that risk and other credit risk and other risks like reputation and fraud is being ruled out, or at least mitigated to the maximum. And once the transaction is running, we actually have a team which is taking care of the day-to-day basis in order to make sure that all the reporting and all the asset performance obligations are being met throughout the entire lifespan, so that the investor is aware that we are running the transaction how it's supposed to be, and that there are no loopholes. So, as a summary, financing gap is widening on a global level, industry-wide, sector-wide, not so much only for the diamond industry. But the diamond industry has seen that actually they need to make changes. So they are following a journey of improvements in order to make sure that they are adjusted to those new funding sources which are now entering the market. Also, the pricing of the diamond transactions is becoming more interesting for these people from the capital markets to enter into it. And there are companies like ours available to structure and manage these transactions throughout the lifespan. So for that reason, for these different topics, we are in the opinion that we think that there is going to be room for an increasing participation from the capital markets in the industry. And we expect this to continue in the future. And as long as you manage the right type of diamantaires and you focus on the right diamantaires, then there is certainly a possibility to run good files and decent transactions. That's it. That's the display. Thank you.
Good afternoon, everyone, and Tom, thanks very much for the introduction. NRF, thank you for the invitation as well, and I think to all of the 5 speakers that have spoken so far, thanks for bringing 5 very different perspectives to the diamond midstream, from the dark arts of the past, of which Chris is such an active connoisseur, to some of the more future-facing initiatives that are now starting to take root in the sector. So, yeah, open books and shared ledgers, capital market investors taking exposure to diamond midstream assets, bond placements. And this is something that sits maybe not quite so easily with the old notion of the diamond business. And Tom, you mentioned this, being opaque, being secretive, and transparency not quite being part of the diamantaires lexicon. Well, I think those days are starting to pass away, and I don't think it's pushing it too strongly to call this a revolution in the diamond midstream. This fact that secrecy is being left in the past now, and transparency is becoming the modus operandi of midstream companies. And I think it was so valuable to have a representative of the midstream in Gert Ovart coming to join us this afternoon. And I use the term revolution advisedly. In fact, I've taken advice from a great political theorist. He lectures at Birkbeck University here in London. He's a Slovenian Marxist by the name of Slavoj Žižek. But his definition of revolution, I think, is a very useful one. He says revolution consists of reasonable people making reasonable demands that, within the current ideology, are impossible. And the reasonable people in this case are probably the midstream's bankers, who were asking reasonable questions a few years ago of diamantaires, saying, well, who exactly are you? And what exactly am I funding? And will I ever get paid back? And how and when? And quite frankly, at that stage, most diamond businesses didn't have a very convincing answer to any of those questions. So revolution is now taking place in bringing the transparency that's starting to support not just KYC, know your customer, but also KYT, know your transaction, and KYP, know your product. So let's look at what's supporting that. And I can really only speak from De Beers' perspective and the perspective of De Beers' customers. And just to put this in context, De Beers is about 1/3 of the market now, we saw from Des's slides, but our customers have all of our rough supply in their hands, plus the rough they buy from other sources, plus the polish they buy from other sources. So probably our 84 wholesale customers might be 2/3 of the world market. So if we can move the dial on our customers' behavior through the transparency criteria we require from them in our contract with them, then we can really move the dial on the whole industry. So let me walk you through step by step the financial compliance standards that De Beers now requires from all of its wholesale customers as a condition of their supply contract with us. So we must have evidence, first of all, of an IFRS compliant corporate structure for the whole siteholder group. So none of these loose family affiliations of Uncle Ranji in Dubai and Cousin Sandeep in Hong Kong, and all of it being drawn together at the end of the year in a Hindu undivided family. We need an IFRS compliant corporate structure. And as an acid test of that, we need an annual consolidated financial statement for the whole group expressed to IFRS. And we need that every year. It needs to be reality, so we need an audit sign-off on that financial statement, and it needs to come from a real auditor. Again, it's not an old family friend, it's not a one-party independent, it's someone who's been through a lot of scrutiny behind the scenes by De Beers. So we have pressure tested all of the audit support that all of our customers receive to make sure that we're happy with the independence of that auditor's opinion. That auditor's opinion is important because we want that opinion to be unqualified on the annual account. So no qualifications on the inventory value, no qualifications on the receivables value, no qualifications on anything. This is a clean audit sign-off every year from a reputable auditor. And the other thing we're looking for on the balance sheet is some real equity there. And again, historically, this is something that Diamontaires have been reluctant to put onto their balance sheets. It's maybe been somewhere hidden away in the family accounts, but we want it visible in the financial statements to the extent that the financial statements can support a maximum debt-equity ratio of 70 parts debt to 30 parts equity. And we want that every year. So it's a mandatory condition of compliance with our supply agreement for all financial statements beginning on or after the 1st of January of this year. So in fact, the crunch comes in the middle of next year when we start receiving these audited financial statements. But let me not underestimate the amount of sheer hard work that's gone in most of these 84 customer groups in getting themselves to this level of compliance. Certainly those loose family affiliations have had to resolve not just corporate structures, but also maybe family politics in coming to an IFRS compliant group structure. And then there's all of the underlying IT systems and checks and controls and integrations that are necessary to support that audit sign-off. This is big work. This is the work maybe not of 1 year, but several years. And also sorting out the equity structures as well. And the good news is that nearly all of our customers are there or thereabouts. So let's unpack that. I take my hat off to Gert once again. I think he was one of the inspirations in giving us courage to go down this path, because his company, Diarough, along with a few others, were real pioneers in this sector and had achieved this level of compliance some 10 years ago. So we knew it was possible, despite many Diamontaires saying it was impossible. So by 2016, a fairly large chunk of our customer base had got there already. On this current year's financial statements, a goodly chunk has got there again. And the great majority are on track for 2017 financial statements as well. So in many cases, they've got all of the supporting structure in place. They just haven't pushed the button because it would involve another 20 or 30 or 40,000 pounds of audit fees. But in some cases, again, there's still systems bedding down. There's been sort of test runs this year. That's exposed issues. They're addressing those issues, or maybe one or two last components of the corporate structure falling into place. But we are tracking these monthly, and it's a big management issue to make sure that we have a fundable and bankable customer base. So we are on these guys every month to make sure they're on track with their compliance roadmaps. And we have to live in the real world, and there are some legacy issues, as Chris was alluding to. Some of those, frankly, will not be resolved. Some of them we're working very closely to push for a solution. But we do have on the customer list a few question marks, and if those question marks can't be answered satisfactorily, we'll be looking to transition supply away from those businesses over the next few months. But overall, a very positive picture, and I think a very powerful platform that we've built in terms of the transparency credentials of our customers, the site holders. And I think the power of a platform, and I heard this from an internet company a few months ago, is that you know you've built a successful platform when people start doing things with it that you didn't expect them to do. And we started going down this path 4 or 5 years ago now, with the thought that these credentials would start to shore up bank support, maybe attract some new banks into the sector. But in fact, what we're seeing now is a whole raft of new initiatives as well, and we've heard a lot about them already today. The securitization vehicles of receivables and inventory, the bond issues, the distributed ledgers now that are starting to take root as well. And what I would say about this is that none of this can really happen without a supporting infrastructure of transparency. Ledgers aren't worth sharing on a blockchain if what's in the ledgers is rubbish. And likewise, receivables, inventory securitizations, they can't get off the ground. Bond issues can't get traction unless the investors, and these are serious institutional investors, can't take full confidence in what they're seeing updated on sometimes a weekly or even a daily basis. So this it doesn't need structures of transparency. That's not enough. What it needs is a culture of transparency. And that really is starting to take root now in the upper echelons of the diamond business. And so that know your customer infrastructure is starting to facilitate a much deeper culture of know your transaction. So assuring the platform is having confidence in the product itself. And I think that has a couple of important aspects that I'd like to touch on. One is the ethical credentials of that product. Has it come from a good pedigree? But also, is it really a diamond at all as well? And yeah, a couple of the speakers already alluded to this, but we have our own very well-entrenched code of social and ethical best practices. We call them the Diamond Best Practice Principles, and they cover all of the reputational issues that you wouldn't want attaching to a diamond. So issues such as money laundering, funding of terrorism, child labour, use of conflict diamonds. These are the sort of things that in a moment can destroy customers' confidence in not only an individual business, but by extension, the wider product category as well. Diamonds are the ultimate gift of love, the ultimate credence product. We have to manage these issues very, very tightly because we don't want any of this bad sentiment attaching itself to our product. And the management of this is extreme as you can imagine. So all of the site holders must sign up to the Diamond Best Practice Principles. They must every year fill in a complete set of self-assessment workbooks for all of their entities, all of their group companies, and all of their contractors as well as doing on-site, as well as doing desktop verification of those. There's a random on-site visit of at least 10% of those entities, and an end-of-year compliance report coming out of that, with some real teeth to the process as well. So remedial actions for issues that we expose, or in the extreme, termination of contract. We have done that in the past as well for non-compliance with the BPPs. And to give you a flavour of the coverage, there's nearly 3,000 entities that are enrolled in this now. It covers around 350,000 employees in 76 jurisdictions. So this is a big and deep and wide-reaching program, assuring the ethical and social integrity of every diamond that goes through these businesses' pipeline. So that's all well and good, but as a couple of the speakers have already alluded to, is it really a diamond? And synthetics, I think, punch above their weight in terms of the publicity they attract compared to the relatively small part of the supply chain that they represent. But I think the message from De Beers is that our three-pronged strategy of disclosure and detection, and one more D whose name I can't call to mind at the moment, has discovery, detection, disclosure. We have many tools at our disposal to ensure that diamonds that are from a laboratory don't get confused with diamonds that have come from Mother Earth. And you can see on the screen one of the telltale signs that synthetics will display compared to natural diamonds. They've got a different pattern of fluorescence. Many other properties as well. There's, if you can have really good eyesight on the orange one, which is a CVD synthetic, you'll see striations or growth lines, just like the growth lines in a tree. And that's a real telltale indicator that that's been grown as chemical vapor deposition rather than as a natural diamond. So building on our scientific understanding of what synthetics do and what they look like and how they behave, we've built a whole battery of detection machines. They're in place now in all of the major gem laboratories around the world. We also have them in some site holder facilities as well. The latest one we unveiled at this year's major trade show in Las Vegas. That's a machine that for the first time ever can detect synthetics in mounted jewellery. So again, upping the arms race once again. But I guess the thought I'd leave you with is that maybe in all of the talk around gem synthetics, we're missing the real story about where the real growth story is going to be in synthetic diamonds in the future. And I say this from the perspective of De Beers' Element 6 division, that's our synthetic industrial diamonds division, where the development teams there are constantly unearthing new and exciting technological applications for industrial synthetic diamonds. And diamond is a remarkable thing. It's not just the hardest substance in the world, but it's one of the very best conductors of heat and also one of the best conductors of electricity. So those two properties, combined with its durability and combined with the unique crystal lattice that diamonds have, lend industrial synthetic diamonds to very cutting-edge technological applications like quantum computing, high-power electronics, water treatment. Would you believe that synthetic diamond electrodes are being used in the treatment of industrial wastewater and soon will be used for desalination as well? So remarkable new applications for industrial synthetic diamonds. In fact, if you're looking for some new hi-fi, go to Bowers & Wilkins, and they can sell you speaker domes that are coated with synthetic diamonds for apparently crystal clear sound clarity. So, so many, I think, growing applications for synthetic industrial diamonds. And that, to my mind, is perhaps the real growth story for synthetics in the next decade. So if in 2030, NRF has one of these forums, and it's not me talking to you, it's a robot, probably the chips inside that robot will be diamond chips rather than silicon chips. So looping back, I think I've gone a little bit off piste in terms of the transparency of the midstream. So that's the real thought I'd like to leave you with, is that things have changed quite remarkably in a short space of time in terms of building the platforms that enable transparency to attract new levels of investment. So this is a field that's opening up quite fast to strata of capital that would have never before taken exposure to diamond midstream assets. So with that thought, I'd like to wrap up the presentation. Thank you for your attention.